Markets are closed today, but we did hear from Fed Jerome Powell. We had PCE data, personal income, and personal spending data that came out. I will go over the highlights of all of this, what this means for our markets, and if indeed we do start to head into a correction, what areas of the markets could see the correction. Keep in mind, correction implies correcting something. What areas need corrected? I'll go over that as well here in this video. Hit the like button and subscribe to the channel because it's free 99, costs you absolutely nothing to do, and you help out a guy making YouTube videos trying to spread the knowledge and the wealth as far as the click can click. But indeed, that is neither here or there. Let's get into it. First things first, we had PCE that came out today, and PCE largely came in line with expectations, but it's not all great because last month's PCE number was revised from 0.42%, revised up to 0.45%, and they round these numbers. So last month, 0.42% was revised down to 0.4%. Now, based on the 3-point upward revision, now your 0.45% is rounded higher to 0.5%. That's a 6% annualized PCE number at last month's rate. Now, this was January's data that was revised. February's data, so last month, PCE on the core year over year came in at 2.8% in February, the lowest in 3 years. The 6-month annualized rate was 2.9% in February, and just for context, it was 1.9% in December and 2.6% in January. So if you look at this chart, this light blue right here is really what you want to be watching. It is the annualized rate over the last 3 months. And the annualized rate over the last 3 months is basically going vertical at the fastest pace that we have seen since about early 2021. So this data today really confirms that you are seeing an upward rise in inflationary pressures. The real question is, does the Fed care about this? And the short answer to that is not really. Jerome Powell says the February reading is definitely more along the lines of what we want to see, even though on a 3-month basis, inflation is actually rising again. Fed Jerome Powell says his first thought on PCE this morning was in line with expectations. Good to see in line with expectations. You guys got to remember something. It is an election year. Fed Jerome Powell is already getting letters after letters from different senators telling them to lower rates. He's very politically harassed right now. Both sides want different things from Powell, and, well, it's putting a lot of pressure on him. If you want my honest opinion, Powell is just begging for a reason to start cutting rates. Unfortunately for Powell, and for many of the government officials that want Powell to start cutting rates, we're just not getting anything yet that would justify the Fed slashing rates. Fed Jerome Powell then goes on to say that reducing rates too soon would be very disruptive. But also, waiting too long could mean unneeded damage to the economy and the labor market. Jerome Powell then says we are ready for the economy to perform in unexpected ways. So he's basically saying, what? Unexpected ways. Like, is the economy going to drastically weaken? And yeah, you're ready to slash rates at that point. Dude, I'm reading between the tea leaves here, and you are begging for a reason to start cutting rates. If the economy does very well, the Fed's not going to just, cut rates or even raise rates for that matter based on that. So right here, he's saying if the economy does take a drastic turn lower, they are going to slash rates. You're talking 50 basis point, 75 basis point rate cuts at an aggressive pace. Jerome Powell says getting it right is the most important thing by orders of magnitude. And he does say we want to be more confident before we cut rates. Fed Jerome Powell reiterated that the Fed has been saying this whole time that there's going to be a bumpy path down to 2%, and we are in the middle of one of those bumps. Whether or not this is truly another rise in inflation or if it's just a temporary bump in inflation, that the Fed doesn't know yet. He says if the base case doesn't happen, we would hold rates where they are for longer. So even if inflation does start to rise again, they're just going to hold rates where they are. Think about it like this. Remember the whole argument that you have to get the federal funds rate above the rate of inflation just to bring it down? Well, that was talked about a lot in 2022. Well, you're now substantially higher than the year-over-year rate of inflation. So you would have to see some crazy spikes in inflation, I believe, to get the Fed to actually start raising rates again. And then last but not least, Fed Jerome Powell says we don't know where rates are going to go back to when this whole thing is over. But Powell did say on the last press conference that you should not expect rates to go back to where they were pre-pandemic or, post-pandemic during the, first year or so of the pandemic around zero. But he said there's a lot of uncertainty around that. So they might go back to that being that low. He also had personal income month over month that came in at 0.3%, a little bit lower than the consensus of 0.4%. That's all fine. That's all dandy. Personal spending was one of the highlights. Month over month, you came in at 0.8% positive. The estimate was 0.5% positive. So people spending money is a good sign for the economy and for GDP overall. Which, with that said, I think the Fed is begging for a reason to start cutting rates at this point, at least Fed Jerome Powell. But based on that data, you're still not getting it. But do remember, the markets would rather have a strong economy and rates stay high than a weak economy with low rates. That really leads me to the first question. How is all of this data and what Powell said going to influence next week? And if you watched the last video posted here on the channel, then you know about 60+% of market respondents to a hedge fund institutional survey CNBC did are expecting the markets to fall from here. That's a pretty high ratio. Take a look at this. This is the Investor AI Sentiment Survey. This survey measures sentiment in the markets. 50% of investors are bullish, 27.6% are neutral, and 22.4% are bearish right now, which last week you were at 43.2% bulls, so that's up almost 7%, from 2 weeks ago to last week. That's a lot. Everyone seems to be positioned bullish, but now coming to expect some kind of market pullback. And that's interesting because when everyone is this bullish, that's typically when you do see a correction happen. Now, the actual word of correction implies that you need to correct something. If you look at the triple Qs, if you look at the S&P, SPY, you've basically been vertical. So that needs to correct. But if you look under the surface of the S&P and the NASDAQ, not everything has done that well, okay? So what really needs to correct? Well, NVIDIA has started this correction phase. Remarkably, NVIDIA just had its first red week since January 1st. The stock was literally going straight up, and it just had a red week. Could the selling get even more extreme there? Probably. What about your other AI stocks like Supermicro or MicroStrategy for crypto? Other stocks that have ran huge in 2024. Those are likely the areas that need to correct. You could throw Meta in that category. You could throw Amazon. You could throw Microsoft in that category as well. I think it's likely from here that we do get a correction, but I don't think everything is going to correct. I think the stocks that have seen the most inflows, your big tech names, are likely the ones that are going to correct. Whereas if the Fed is going to start cutting rates, if they're not concerned about inflation, the economy is holding up, that would be a good time to invest in small cap stocks when, let's face it, small cap interest rate sensitive names have underperformed big time in 2024 compared to the S&P, compared to the NASDAQ. I think that area of the markets may have already corrected, and you're just waiting on the rest of the markets to see that correction also. It would not surprise me to see the start of a correction coming next week. On Monday, you have ISM manufacturing PMI that comes out. On Tuesday, you have JOLTS job openings as well as the ADP employment change. Wednesday, you have ISM services PMI. And Fed Jerome Powell speaks again on Wednesday. I think we understand Powell's stance at this point. He's full bull out there. He is full on bullish. He's just begging for a reason to start cutting rates. But on Friday, you have your non-farm payrolls report as well as your unemployment rate. If there was a week in which we could start a correction, it could be this upcoming week. We do have some earnings coming up as well. PVH, Canoe, Monday and after hours. Paychex, Tuesday pre-market. Dave & Buster's and Cane Maine Foods, Tuesday after hours. BlackBerry, Levi's, Wednesday and after hours. Conagra Brands, some other food companies as well, Thursday pre-market. And then these two stocks here, Friday pre-market as well. But we're going to be starting up earnings season here in just about 2 weeks or so. Let me know what you think about this information down below in the comment section. Are the markets getting ready for the next leg higher or a correction? I will tell you the NASDAQ did close under this lower end trend line. If we do have a red Monday or a red Tuesday, we start to fall back down. The next level you could test is that 438.60 level on the triple Qs. If you fall under that, then you got to start looking at your major moving averages. 50-day moving average at $433 per share, 100-day moving average at $413, and 200-day moving average down at $390. With that said, hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day and weekend. I will see you in the next one.